Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Monday, December 19th, 2022. It is 11:44 a.m. Eastern Time as I'm starting the video. This will be a brief one. There's not a lot new to report. I'm going to keep this limited to the equity markets, share my thoughts. I did already get a couple posts out to you today, so not much to add to that. The big takeaway is I think we've got the bull by the horns here, metaphorically speaking. With those recent short trades. Again, that's scaling in this red zone here on SPY. Again, the pre-market was the well, we'll see. I mean, at this point, even if you're just an active swing trader, you can't argue that wasn't a golden shot. That was one of the biggest drops. It's at least 10% in QQQ. Let me see what it was in SPY here since last week. That's 8% drop in SPY and better than a 10% drop in QQQ. But I think we're going to get a little bounce here now. I showed you these support levels this morning. 381.25 on SPY right there. You can see that defines the bottom of this gap right here, at least the top of that candle. That's how I'm measuring the gap on this one. Plus, I've had that line there for a while. It's a former support resistance level. And keep in mind, we're very oversold. That's, as I just told you, better than an 8% drop just a few days in the S&P 500, better than 10% in the NASDAQ 100, S&P 500 right here on SPY 60-minute chart. What I did is I put up some fibs for you, and we have both the S&P 500, that's the mid-October lows, into the recent highs right here. Measure that, and that puts us right at the 50% retracement so far, meaning we've dropped just in a matter of a few trading sessions there, retraced 50% or half of that rally off the lows there. That's a key Fibonacci level. Buyers are likely to step in. So I just reversed right before starting this video. What I said is, and I take it literally. I'm becoming less and less inclined to game these counter trend rallies, but the active trader in me, when I see an opportunity, I'll take it. So now where to? Well, golden re-entry, and I don't doubt that some of you may not have your full allotment yet of shorts. Right there, 390. Look at that. That was that support shelf. Remember, this was that recent trading range here. Said we would likely enter leading up to the big Fed meeting in December. Markets ground around sideways, gave us that pop. Again, not reflected all the way up there in pre-market. Golden shorting up, and then boom, right down to resistance. You get pretty oversold when you go down to the short-term time frames like the 60-minute chart. You can see here on the very bottom is your RSI. That's an indicator that shows you how overbought or oversold things are. And that's it. We're well below the 30 level right there, which denotes oversold. We were pretty oversold there, and then you became less oversold with positive divergence. So, if anything, just maybe a little pop here, not at bottom. And like I said, it's hard to gauge when you're going to bounce and how far, but the way, and I hope I made that clear today, if and as, I'd prefer to see a reaction here to work off the oversold conditions. So I'm going to try to game a little one here up to, but no more than just below that 390. The resistance is around 390, give or take, but you may want to either keep your stops tight if you're trailing it up, or reverse a little shy of that level. And then, so if we can do that, we get a little bounce here, work off the near-term oversold conditions. That'll set the stage for the next leg down. And then, as I've been talking about for a while, I think once you take out this support level, more and more stops gets hit. It's a vicious cycle. The bulls, especially the JCL longs, so I call them Johnny come lately, that didn't want to buy here. They wanted to buy here, buy that pop that morning. They start getting underwater. Their positions are going, their losses are getting bigger and bigger. And depending, again, where every individual bought and his or her stop allotment, more and more stops are going to get hit. Active, flexible traders like myself. Like myself. I'm still a still foggy-headed from the flu. I've been coughing. That's about most of it now, but a little foggy-headed still. Anyway, those type of traders will, smell blood in the water. Shorts are, we're we're opportunists. We see an opportunity, we take it, and so that's what tends to happen. So you have that kind of a vicious cycle. Selling begets more selling. Margin is hit. Remember, at any point in time, even in a bear market, the vast majority of participants are long. They're not short. Short interest can get relatively high, but you're never going to have more shorts than longs in the market. And so those longs that are on margin, you know, even if they're what they call diamond fisted, they get sold out by their broker, even if they won't want to sell. And so keep an eye on that, and also you want what I'll watch for that helps to determine if and when we get in that very strong waterfall type selling is how many other things are going down. This time around, I think we could see, you know, a broad-based sell-off, and if you see that, you see gold and silver and you know, Treasury bonds all going down as well. Then you know those people, you know, generally speaking here, that you know, are quote unquote diversified. Well, if everything's going down, then they're going to get either they're going to feel the pain personally and pull the plug, or the broker's going to pull it for them in the form of margin selling. So, all right, so here's, you know, my best guess. Get something like this, boom, and then like I said, the next solid break of below 380 on SPY, and that's just SPY. Let me park this away. I was gonna digress for 1 second. I was gonna update that, but there's no reason to update. I told this is something we watched for a long time, and it was one of many reasons to get short up here and add to these shorts. Those bearish crossovers on the PPO on not just the S&P 500, not just the Nasdaq 100, the Russell 2000, but every single sector in the S&P 500. So on a scale 1 to 10, this was a 10, shorting up here in this, especially in the bounce into that trend line. Just there couldn't be really much more evidence to you know, make a case to get back into some swing short positions. So anyway, that's support now, and like I said, near term oversold, and you know, like I said, any bounce I think will get sold into sooner than later. QQQ, the Nasdaq 100, also at support. I can play around with this trend line, but this is the way I have it drawn here. You can see, let me change my tool here to a line tool. Boom, boom, boom. If we get a reaction here, that'll validate it. You've got a, you know, one here, a couple reactions there, and then you can see really nice what I call support zone. Two support levels in close proximity. You have the previous major bear market low right there back in mid-June. You tested it there and bounced off it the first time, then you broke it. You kind of went through it a couple times, but there's enough there, including and not limited to this recent gap right there. So a lot of support we're coming up on, and again, that taken in conjunction with a drop of, remember, we were at that 303 level right there at the trend line in pre-market when we had that golden short last week, and that is a 11.2, 11 and a quarter, better than 11% drop. So yeah, I think if you, even as an active trader, like I said, I'm becoming less and less, and will become less and less apt to game the counter trend rallies, but we're not in waterfall mode yet. It's been a powerful down, but I think it's a good time to game a bounce. And you can see there 280, big support, or I'm sorry, big resistance right there on QQQ. It defined that whole trading range we had leading up to the Fed, and it was cooler than expected CPI, and there was the hopium rally into the Fed right there, and that was our, right up there was our last short entry. So that's it. So maybe game a little bounce here if you are an active trader, and if not, then nothing wrong with that. Just if you get a bounce back anywhere close to 280, that would be an objective level to add. There's no guarantee we stop there. There are no guarantees in the market. The only guarantee I ever give anybody about this game, you know, trading, and this website, is I will be wrong, and I'll be wrong a lot. So don't, you know, don't put all your eggs in one basket. Don't put too much into any one, you know, trade, no matter how confident I might sound or how confident you might be. Just I trade in probabilities, not certainties, and that's it. So that'd be a high probability short entry if we can get back there. even if we, get back to the trend line, even if we had another run at the 200 days in the downtrend line still. But at this point, I'll tell you what, it may behoove you to revise your trading plan if you did take those, those short entries starting out here at the bottom of the scale and zone, and then right there recently at the when we popped there, and that was right here pre-market last week. That was on Tuesday, right? Yep, that was Tuesday's candle. Then your average cost is around somewhere in the middle there, about 300. There's no reason to let that. You could set a stop at least at break even, and or even lower than that. Now, like I said, this is a good position to be in if we are going lower, because you're profitable enough that you can add into rallies, or if we don't rally back to 280 or anything like that, you can certainly add on a break down below the bottom of the support zone. You want to see SPY give way as well. All right, let me get the histogram out of the way. Everything's still red there on that one particular trend indicator. So I'm going to park that and give you very short term. Go down to 60-minute chart. I think I just did that. If I didn't, you have this is the recent low mid-October. I showed you on SPY, but here's QQQ right into the recent high. I measured this line here, measures that move, and from high to low, or low to high, and we are to the button right on the 61.8. I know it's hard to see in the video. I cannot make these numbers any bigger. That's a limitation of this particular charting platform, but I can tell you that's it. So we are again at the 61.8 retracement of the rally off the October lows. Buyers step in often at these key Fibonacci levels, especially when you have both the QQQ and SPY there. So that makes a case for maybe a quick bounce trade. All right, now let's take it out longer term, because that's more and more where I've migrated my focus towards. Remember, just kind of recap again, go back to QQQ. It's stated for the last several weeks plus, with the big Fed meeting coming up and the holidays. I told you that's when I typically go into more active trading mode. I told you it's tough as to trying to extract money as a swing trader, so that was the realm of the active trader, and it turned out to be we were in a little grinding range. And now that the at least the Fed's out of the way, we're still in the holidays, don't get me wrong, but again, we had that rally into there where they sold it out hard, and because we broke down from the trading, this right here, of all the things that happened in the last 2 weeks, I'm going to tell you two things. Keep it very simple, and these were all highlighted at the time. I know I sit here and I talk sometimes for 30 minutes or more, but the two most significant developments on the most important time frame would be the daily, and that was that pre-market pop right into the 200-day moving averages on the S&P 500, the Nasdaq 100, the primary downtrend lines, and then following that, you got a rejection there, of course, and that was key to see the rejection. But then this right here, the breakdown below those recent trading ranges. So 1, 2, and that's it. So there are no guarantees, but those are check marks. Those are big check marks for the bearish case. And so as long as those check marks aren't undone, what does that mean? Well, if you take back 280 with conviction, you're back into the trading range. And when that happens, usually you head back to the top of the range. And then if that happens, then you're going to make another run at the trend lines in the 200 days. Do we? If so, it would be another objective short entry. But if we take those out, then boom, you just negated some nice check marks for the bearish case. But as of now, those check marks are very well intact, so there's no reason to second guess it. Long-term stuff, I covered that this morning. This has not changed. I threw all of these targets out. 1, 2, 3, 4. This was my primary trading index. Beginning of the year, we had sell signals here. These were from this, what I still consider the trend trades. Now we've reversed. I have, and I made it very clear that these bear market rallies, even for a trend trader, when you get divergent lows on the 60-minute, especially the daily time frame, even then you might want to cover shorts and go long for those bear market rallies, because they're that big in scope. It's worth it, the percentage gains. But that was our first sell signal there on that trend line break, and then our second. So that was our average entry there on the swing or trend trade. First target hit, bounce. Second target hit, bounce. third target hit right there. Significant rally right again into the 200 days, just like the previous one. Boom, boom, boom. I mean, this is just a textbook bear market, and very, very, very clear and objective entries. And so that's why those levels are well watched. If they pop it, well, they're going to run up maybe at the top of the upper bounce target zones. But as of now, they haven't. So we're still not, not out of the woods yet. We're not all clear, I should say. We still have an uptrend line off the lows. That's what I just showed you on the daily. And remember, this is also that former T3, my third target from early in 2021, 268, and or the trend line that I had. We hit it there, and then we hit it again, and we're back on that level now. So next target's down here. It's T4 around 235, 236. I also have that alternative blue trend line, but I'm favoring. I think the trend line will probably get taken out. We'll probably head on down there. And then longer term, we have the primary, that's just yellow uptrend line. I'm going to zoom in nice and tight. That goes off the 2008 lows in the NASDAQ 100 and the 2009 early 09 low. Every other index bottom March of 09. NASDAQ was a little bit early, but pretty much put a double bottom in. And so we took that one out there back. These are monthly candles, a few months back. And we've been trading below it. We back tested it here. We back tested it again. And we did that. So that was intersecting multiple resistance levels. The uptrend line, the downtrend line. And then you have one of my favorites here, this blue dashed line, the 20 period exponential monthly average. We're below that. And we have been since here. So this is very simple but highly effective bear market trend indicator. We broke it back here, all the way back here. This said, on that long-term monthly, hey, you're in a bear market now in QQQ when you had that solid close below it. And then you had multiple opportunities to short it on the back test each month. And that was an intra-month break, but a failure, one failure, another failure, another failure. And we're still below it. So that's another thing that that will chip away at the bearish case if we have a solid monthly close back above that 20-month average. And same thing with the S&P 500. The S&P 500 tried to take it out here, but we didn't. Remember, you want to see it on both the NASDAQ and the S&P 500. So we're still below it. We took it out way back right here. That was the breakdown candle. Back test, back test, back test, back test. And we're still below it. And we're below the primary uptrend line. We got rejected on the downtrend line. So there's not much more to add. This is it. These are long-term trend indicators. Short-term, like I said, a little bounce here right now, most likely. And then back down. Update, TLT. That was my pick du jour last week on that breakdown candle there. 1.8% down in TLT. That's usually about as big as it gets. That's a big move for Treasury bonds. And so far so good on that short. There's a bearish PPO crossover on the daily time frame here. And again, that PPO is just a nice trend indicator. It says, hey, when it's green, the trend is bullish. You want to be long and strong. When the PPO histogram is red, the trend is bearish, and you want to be short or respect that trend. And of course, I like to use this in conjunction with other things such as that sell signal we had last week. So we're at the first support level, or target I gave you last week, 104.72. Based on that trend indicator flipping, yeah, we'll probably get a reaction here, maybe a little consolidation, but I think we'll continue on down lower. And let me show you ZB. That's my proxy for the bonds. Treasury bond futures ZB right here. You have a decent support level as well, 129, 154. This is the 60-minute chart. These are hourly candles, 3 months. There's a little bearish rising wedge. There was a breakdown last week, back test if you missed it. And you can take the quick profit here if you want, or wait for break of that. And I would say we're going to probably a little bit of support here. I'll give you 2 additional targets right now, right about here and right about here. and that's 128, 135, and then 125, 306. Oh yeah, and yeah, I think I told you I'll stick to the equity markets. It's short, so I'm just gonna wrap this one up with one more. The Euro US dollar, which is most likely going to impact the both the stock market and gold and silver. Remember, this is a daily chart. Is our downtrend line right here, primary downtrend line, and we're still within very close proximity. You have this bearish rising wedge right here with negative divergence on it. And so once we break that, a lot's going to happen. Number one, you're going to have a sell signal and a breakdown below the bearish rising wedge. Again, if that, look for that, and that would be your sell signal. Number two, if that happens, then you're going to have a failure. This whole thing right here will be a false breakout, and that's a pretty bearish event. And as I said last week, I think that will send us down here, and that is about to the 1.02854 level and the uptrend line right there. That would be where euro US dollar pair would likely bounce. But keep in mind that the euro has an inverse relationship with the, I'm sorry, a positive, the euro, yes, which is what we're looking at here. Euro US dollar is the euro against the dollar. And it's positively correlated with the stock markets. That's what the white line is the euro US dollar pair. The green line is the S&P 500. And as you can see, they move up and down together. So you can see that the S&P has already started moving down. The euro hasn't gotten the memo yet. And so if it does, it's going to head down as well. There'll be a mean reversion here. It means one up, the other down. I think it's going to be the euro down. And because of that, also don't forget that, or let's not forget that gold is also has a high correlation, a very strong correlation with the dollar. So gold and silver will likely come into pressure as well if we get that correction in the euro. And then if you look at the weekly chart, there's the weekly downtrend line right there. Ran into it last week, still struggling with it. And, so like I said, favor a pullback. Longer term, I remain bullish euro, bearish dollar, which is to be bullish gold and silver, and bearish equities as well, based on that relationship I just showed you. That's longer term, but near term, you get the pullback. I'm sorry, that would be, yes, this going down. You can see that's coincided at least most of the year with the drop in the stock market. And so longer term, if that goes up, this rally has coincided with an up in the stock market. We'll see. These relationships are on and off. I probably made that overly complicated right now. So what I look at is what's happening most recently, and that is, again, when you go back, this is a daily chart, so you can see from the beginning of the year, you can see the correlation was strong. But then you roll back far enough, and you see periods where they had an inverse relationship. So it's kind of an on-off thing, like a love-hate relationship, or on-off. It's people that break up, get back together. And right now, these two have been, at least for the last year or so, or all year in 2022, they've been together pretty strong. All right, let me see if I can give you some bounce targets. I need to figure them out myself since I am long now for the day of the Qs. This is a 60-minute chart of NQ, NASDAQ 100 futures. You can see there's a divergence that's been building. Would have liked it better to get down to this trend line. Maybe we will. That would be a more objective entry, and there's also price support there. That is, I'm going to measure it out. That's about 1.5% below where we're at least the 11,044 level. Trend line might come in a little earlier there. So you can see we have what I call potential but unconfirmed divergence. Potential meaning you have lower lows in price and higher lows in the indicators, but these are momentum indicators, and the PPO and the RSI, but the PPO is pointed lower. So you need to turn around and reverse here, and then you'll have confirmed divergence, and that could give us that rally. And I'd say minimum bounce right here to this little area here. We had some consolidation, a couple reactions there. That's 11,493, give or take. Max bounce target there. But also look at those levels on SPY and QQQ I gave you earlier. That would be those be levels to look at. So It wouldn't surprise me either if these divergences don't play out yet. I may have to throw this hand away on the bounce trade. But like I said earlier in the post, swing trend positions, those are locked in. I've got some golden entries on those. Scaling back into those at least at this point in time. But then the active trading account, I'll, when opportunities arise, but if we start to continue, if we do continue lower, not start to continue lower, if we continue lower, ideally again after a bounce and we start to take out these support levels I just mentioned, that's where I suspect the selling will begin to accelerate, and then I become increasingly less interested in gaming counter trend rallies. Because I think it'll be a quick swoon down as more and more bulls realize that their Santa rally Santa didn't come and give them the Santa rally they were looking for and all that good stuff. All right, I'm going to wrap it up here, get the video up to you. I'll be interested to see how quick this one processes. My son's home from college. My oldest, he built most PC gamers, built his own PC, and he just built a brand new PC for me with all state-of-the-art, top-of-the-line stuff. It should supposedly rip this video up in a fraction of the time my previous computer was doing it. So we'll see. All right, let me try to get this uploaded, get it out to you, and if I see any other opportunities, I will get it out to you. I looked at crude, I looked at natural gas, I looked at crypto. Nothing's jumping out at me right now, so I think just keep things relatively light right now. And if I see anything, of course, I'll get it out to you. But as of now, what I covered are the main things I'm watching and trading. This has been Randy Finney with Right Side of the Chart. Have a great day.